What's up, investors? It's the Russian dude. Let's immediately talk about these particular 7 companies which you should be very careful about investing, and these ones are Magnificent 7: Amazon, Apple, Alphabet, Meta, Microsoft, Nvidia, and Tesla. I'm almost certain you have at least one of these companies in your portfolio, maybe even more than this. According to this graph, approximately in the middle of May, 51% of investors had these companies inside their portfolios, which shows you that the allocation of invested money in these just 7 companies is huge, to say the least. And in the S&P 500, just these 7 companies alone, its total weight reached approximately 31%. You heard it right, 7 companies are responsible for 31% of the weight of the S&P 500, while the remaining 493 companies only responsible for 69. And honestly, we can go even further. If we take only 3 companies out of this Magnificent 7, specifically Apple, Nvidia, and Microsoft, just these 3 companies alone represent approximately 20% of the S&P 500. The reason I'm saying all this is to obviously show you that the top of the S&P 500 is overcrowded with these companies, and these are massive. Majority of them are trillion-dollar companies. It is extremely complicated for them to continue to maintain the double-digit growth unless you're a unicorn company. For this reason, since they are experiencing right now pretty good growth opportunities and pretty growth in general, well, the further they go, the more complicated it will become for them to maintain these levels of growth. And according to this next chart, as you can see right here, the growth of these particular companies in comparison to the S&P 500 will most likely be slowing down every single next 4 quarters. In the meantime, the S&P 500 is expected to grow. And obviously, a lot of investment companies and organizations, they create these ETFs, which allow you to invest in every single one of these Magnificent 7 by just making one single investment into so-called blue chip ETFs. And well, as you can see, one of the most recent graphs shows that the outflows of these particular ETFs reached a very significant levels. And just to sum it all up, whenever a lot of investments, a lot of money, a lot of growth is concentrated in a very small part of the stock market, this should give you some concerning signs. Remember 1980s, dot-com bubble, the great financial crisis, 2020, a lot of this crisis, a lot of these market downfalls, just before they started to happen, a particular industry or a sector, they were overcrowded the same way what we see right now. The best example would be the dot-com bubble of 2000. And just for example, according to this graph, as you can see right here, the peak of the dot-com bubble was approximately in March of 2000, and just in 2 years, just until 2002, October, the decline was more than 80%. Because just think about it logically, this Magnificent 7 cannot grow indefinitely. Unfortunately, neither of those companies will not become a $10 trillion company while maintaining the same level of growth and take, I don't know, like 80% of the S&P 500. It just simply does not make sense. The math does not work in this example. So it only makes sense, it is only a matter of time when the growth will slow down, the investors will start taking their profits, start selling their positions, and inevitably majority of these companies will go down or they will underperform in relationship to the S&P 500 index. And the higher the growth of any individual company of this Magnificent 7, for example Nvidia, which experienced like triple or not like quadruple digit growth in the last couple of years, the higher the growth, the stronger will be the fall. I'm not saying it is going to happen, but, well, that's usually the case according to the history. But luckily, there are similarities and differences between the dot-com bubble and the situation what we have right now, so let me just summarize the whole video by speaking about those 2 things. So, obviously, the dot-com bubble was about the technological stocks, and this Magnificent 7, all of them as we can see right now, are from the very same industry. The optimism about this particular industry right now among investors is higher than usual. Another similar thing is that also during the dot-com bubble, just 4 companies were responsible for a major part of the S&P 500, specifically Microsoft, Intel, Cisco, and Dell. And well, pretty much only Microsoft remained the king. And then the interest rates by the Federal Reserve were approximately at 5.3%, which is exactly the same what we see right now. The current interest rates are between 5.25 and 5.5%. But fortunately, there are differences between current situation and the dot-com bubble. First of all, specifically, these Magnificent Seven are much more established companies with much more confident revenue growth, and these are not just some random companies. If you just add something .com in the name of your corporation, the share prices will skyrocket within several months. And another thing is that the PE ratios and forward PE ratios of those technological companies back in the dot-com bubble were almost twice higher what we see right now. So, long story short, potentially yes, there is still room to grow for these Magnificent Seven companies, but the downside, unfortunately, is getting a little bit more dangerous with every single day. Potentially, yes, we might experience, I have no idea, 5, 15, 20, 30% growth until a correction hits those companies and bring them down more significantly what they used to be. There you have it, guys. Thank you so much for watching. Please like this video, subscribe to my channel if this was interesting or informative or both, and see you on Monday.